In the annals of finance, a recurring drama plays out. A company rises, propelled by innovation, hype, and billions in capital, only to spectacularly collapse in a fraction of the time it took to build. One moment, it's hailed as the future, the next, a cautionary tale.
What drives this rapid undoing?
Our investigation suggests a potent cocktail: the magnetic pull of charismatic founders, the overwhelming flow of blind money, and a story so compelling its silence is all skepticism. We will dissect the anatomy of these billion-dollar implosions, examining why smart money and seasoned professionals often miss every glaring red flag. Central to many high-profile collapses is the figure of the charismatic founder. These individuals often embody the company's vision, projecting an aura of confidence and conviction that inspires loyalty and attracts investment. Their personal story becomes inextricably linked with the brand, making it difficult for stakeholders to separate the founder's persona from the company's underlying fundamentals. This magnetism can, however, create an environment where critical questions are left unasked and uncomfortable truths remain unaddressed, paving the way for eventual systemic failures.
Consider Adam Neumann, co-founder of WeWork.
Neumann, a figure known for his grand pronouncements and unconventional leadership style, positioned WeWork not as a real estate company, but as a technology and community platform.
His charisma was undeniable, attracting fervent employees and eager investors. Reports from early employees described his ability to inspire cult-like devotion, blurring the lines between work and personal life. This powerful persona, according to numerous reports, became a shield, deflecting scrutiny from the company's rapidly escalating losses in questionable business practices. WeWork's narrative, fueled by Neumann, was that of a disruptive tech company transforming the future of work. However, underlying its glossy veneer, financial filings revealed a company with traditional real estate economics, long-term lease liabilities, and short-term flexible rentals.
While Neumann articulated grand visions of elevating the world's consciousness, the company consistently reported substantial losses. In 2018 alone, WeWork's losses reached $1.9 billion. This fundamental disconnect between the founder's vision and the company's operational reality was consistently obscured by the relentless pursuit of growth and an intoxicating story. The second critical component in these implosions is the abundance of blind money, capital invested with an emphasis on rapid growth and market share, often at the expense of profitability or rigorous due diligence. Venture capital, in particular, frequently seeks out charismatic founders and disruptive narratives, sometimes overlooking fundamental business metrics in the race for the next unicorn. This flood of capital allows companies to burn through billions, postponing the moment of truth when their business model must stand on its own financial merits, creating a dangerous feedback loop. Elizabeth Holmes, founder of Theranos, provides a stark illustration of blind money at work. Her compelling narrative of revolutionary blood testing, combined with a striking resemblance to Steve Jobs, drew in an extraordinary roster of investors, including high-profile politicians and business magnates. Despite never publishing peer-reviewed data on her technology, and with minimal scientific transparency, Theranos raised over $900 million. This blind faith, fueled by the desire to be part of a groundbreaking healthcare revolution, allowed the company to reach a peak valuation of $9 billion without ever demonstrating a working product to independent experts. The chasm between perceived value and actual financial health in these cases is often staggering. Consider the investments made. SoftBank alone poured over $18.5 billion into WeWork. This was against a backdrop of WeWork reporting a loss of $1.9 billion in 2018. Similarly, Theranos secured over $900 million in investor funds based on technology that, according to later investigations by the Wall Street Journal, fundamentally did not work. These statistics paint a clear picture of how investment capital can detach from traditional financial realities when a compelling narrative and charismatic founder are at the helm. The third pillar of implosion is the story too good to question. These narratives often promise to disrupt entire industries, solve grand societal problems, or deliver unprecedented returns. They are crafted to appeal to a collective ambition and a fear of missing out, or FOMO. Once such a story takes hold,
it can create an echo chamber where internal and external critics are dismissed as lacking vision or understanding.
This narrative effectively becomes a barrier, preventing objective scrutiny and allowing critical red flags to be rationalized away by believers caught in the hype cycle. Sam Bankman-Fried, the founder of the cryptocurrency exchange FTX, masterfully crafted a story too good to question. He cultivated an image as an effective altruist, appearing in media as a responsible, even savior-like, figure in the volatile crypto world. This persona, combined with FTX's rapid growth to a $32 billion valuation by January 2022, allowed a complex and opaque financial structure involving his trading firm Alameda Research to largely escape serious scrutiny. The narrative of SBF as a benevolent genius shielded investors from understanding the precarious interdependencies and potential liabilities that lay beneath the surface. The unraveling of these companies often highlights systematic failures in the due diligence process.
How could billions be invested without fundamental checks?
Investigations reveal recurring patterns: a lack of truly independent financial audits, insufficient technical verification of proprietary technology, and an over-reliance on the founder's personal brand.
In many cases, boards of directors, rather than providing oversight, became cheerleaders for the founder's vision.
This absence of rigorous, objective analysis at crucial stages allowed fantastical claims to stand unchallenged. Corporate governance, designed to provide checks and balances, frequently faltered in these high-growth entities. Boards were often stacked with allies of the founder or individuals lacking the independence and expertise to challenge ambitious, yet often unsubstantiated, claims. WeWork's board, for instance, drew criticism for approving transactions that benefited Adam Neumann personally, including the company paying him millions for the We trademark. This pattern of board passivity or complicity meant that crucial corporate decisions and financial disclosures went largely unchallenged, eroding accountability and exposing the company to undue risk. The contrast between effective and ineffective boardrooms is stark. An effective board, characterized by diverse expertise and independent voices, challenges assumptions, demands transparency, and prioritizes long-term stability. Conversely, an ineffective board, often composed of loyalists or individuals susceptible to groupthink, can become an echo chamber. For example, some argue that Theranos' board lacks sufficient medical or scientific expertise to adequately challenge Elizabeth Holmes's technical claims, relying instead on her persuasive abilities. This comparison highlights how leadership structure directly influences a company's susceptibility to risk. Within these companies, warning signs frequently surfaced, only to be dismissed. From former employees raising concerns about Theranos' technology to analysts questioning WeWork's valuation, skepticism was often actively suppressed or simply drowned out by the pervasive hype. Insiders who tried to speak out faced retaliation or dismissal. The story too good to question created an internal and external echo chamber, where dissenting voices were marginalized and critical data points were ignored. This deliberate or unwitting suppression of negative information allowed problems to fester and escalate unchecked. The media often plays an unwitting, yet significant, role in amplifying the hype surrounding these companies. Early glowing profiles, breathless features on founders, and uncritical acceptance of grand claims contribute to the story too good to question. Journalists, eager to cover the next big thing, sometimes prioritize narrative over investigative rigor, further cementing a company's inflated image. This media echo chamber can make it incredibly difficult for the public, and even potential investors, to discern fact from fiction, inadvertently assisting in the creation of a fear of missing out mentality. Underpinning many of these investment decisions is a powerful psychological driver, the fear of missing out, or FOMO. When a company is generating immense buzz and achieving sky-high valuations, investors, from venture capitalists to institutional funds, become increasingly reluctant to be left behind. This herd mentality can override logical risk assessment and fundamental analysis. As Sir John Templeton famously warned, the four most dangerous words in investing are, "This time is different." Yet, in the rush to secure a piece of the next perceived unicorn, many succumb to the belief that historical precedents no longer apply. The speed of collapse, often measured in days or weeks, is a direct consequence of trust evaporation. Once the compelling narrative is shattered, whether by investigative journalism, financial disclosures, or regulatory action, the collective belief that sustained the valuation rapidly dissipates. Investors, employees, and customers, suddenly confronted with inconvenient truths, withdraw their support en masse. This immediate loss of confidence creates a catastrophic chain reaction, where access to capital dries up, partners flee, and the once invincible company finds itself facing insolvency with breathtaking speed.
FTX provides a chilling example of this rapid unraveling.
On November 2, 2022, a CoinDesk report revealed that Alameda Research, Sam Bankman-Fried's crypto trading firm, held a significant portion of its assets in FTT, FTX's proprietary token.
This raised immediate concerns about FTX's solvency. Within days, Binance announced it would liquidate its FTT holdings, sparking a run on FTX.
By November 8, FTX halted withdrawals, and by November 11, the company filed for Chapter 11 bankruptcy. An estimated $8 billion or more in customer funds were missing. The story of reliability crumbled in less than a week.
Another contributing factor to these rapid implosions is often the lag in regulatory oversight.
Particularly in nascent or rapidly evolving sectors like biotechnology and cryptocurrency, regulators often struggle to keep pace with innovation.
This creates a fertile ground for unchecked claims and opaque financial dealings.
By the time regulators, such as the FDA in the case of Theranos, or various financial bodies investigating FTX, step in, the damage is often already done.
The absence of proactive, sector-specific regulation allows companies to operate in a gray area, exacerbating risks until the inevitable collapse.
In the aftermath of these spectacular collapses, the narrative shifts from boundless potential to criminal investigation.
Founders like Elizabeth Holmes and Sam Bankman-Fried face legal battles and prison sentences. Investors grapple with billions in losses.
The once heralded companies become symbols of corporate hubris and unchecked ambition.
The painstaking process of untangling complex financial webs and allocating blame begins, often taking years.
The consequences are far-reaching, eroding trust not just in the individual companies, but often in the broader industry or investment landscape that allowed such failures to occur. The anatomy of a billion-dollar implosion reveals a persistent pattern. It begins with a charismatic founder who crafts an irresistible narrative, attracting an abundance of capital that, in its eagerness, becomes blind to fundamental risks. This potent combination creates an environment where scrutiny is replaced by belief, and red flags are dismissed as minor obstacles. The lesson is clear: the bigger the hype, the harder the fall. Until investors, regulators, and the public at large prioritize critical analysis over captivating stories, this cycle of rapid rise and even faster collapse is bound to repeat.